Glynn Goodwin Co, a name synonymous with quality and performance. If you don't already know us, let's get acquainted. If you do, then you'll be delighted to see that we are still in the forefront in using the most sophisticated of methods to ensure our clients' investments are well managed. After 5 years of managing clients' investments successfully, we recognize the need to not only create capital growth, but just as importantly, preserve it. Come join our special guest, Magnus Magnusson, to see why we are celebrating our break from the pack and your chance for investment success.
Hello, the title of this program is Everyone's an Expert. Is it true? Well, we shall see in a moment, but right now, let's play Mastermind. And our first contender is Mr. John Barker. Your occupation, Mr. Barker?
I'm a financial advisor with a leading consultancy company, and we've been providing expert advice on investments for over 50 years. And I can safely say...
I'm sure you can, Mr. Barker, I'm sure you can. Now, what is your chosen subject?
Investment performance, 1970 to 1984.
All right, Mr. Barker, your time starts now. What would a £10,000 lump sum have returned from investment bonds on average from 1975 to 1984?
£39,584.
Correct. And its real value after inflation?
£13,239.
Is correct. Now, if someone invested £2,000 a year over the same period into the average pensions managed fund, what would be the value?
£58,300.
Correct. And with inflation?
£19,498.
Correct. Now, taking the average again, this time of unit trusts, what would £100 per month have grown to?
£43,519.
Correct. And its real value after inflation?
£14,555.
Absolutely correct, Mr. Barker. If you had simply spread £10,000 equally across the FT30 share index and left it, what would it be worth?
£101,910.
And with inflation?
That would be £34,084.
Correct. Now, to what level did the FT30 fall in the 1974 collapse?
Oh, I know this. From 510 down to 146 in under a year.
Correct again. Now, as a result of the move in the Australian market from 772 to 941, would a British investor have made a profit from this 22% rise?
Well, yes, of course.
Wrong, Mr. Barker. A British investor would have lost 15% because of the difference in currency values. Now, which unit trust during the 80s made gains more than twice those of any other unit trust?
Well, I'm not sure. Was it an American fund?
No, it was in fact the Japan Trust managed by Fidelity International.
Really? Oh, I thought...
Now, Mr. Barker, let us turn to the future. Faced with the wide choice of funds available today, which would you advise as a likely high performer?
Well, it depends on my feel of the market. What the managers are saying. It's difficult to answer. I'm not sure it's relevant.
All right, Mr. Barker, how would you ensure that the fund you choose would be the leader in its market?
Look here, I'm an expert on past performance. How can I answer that? I mean, no one can forecast these things. This is not fair. I protest. How dare you?
But you can, Mr. Barker, you can. With new techniques, investors no longer need to be in the dark about their future. So now you know the reason for calling this program Everyone's an Expert. Poor Mr. Barker. Like many experts who rely on past performance, his advice is rarely based on fact, but rather on opinion accumulated from a variety of sources. And that's why many millions of pounds are simply locked away in building societies or banks, or why, in real terms, investors often take the easiest route to losing value on their capital. So what's the answer? Choose an advisor who has the means to pinpoint the growth areas of the greatest immediate potential, and more importantly, who knows when to switch into and out of a particular fund. The greatest long-term growth can only be achieved by short-term management. Well, this service is now available from only a very few highly qualified and enlightened financial advisors. A large proportion of the nation's investments ends up on the stock market in one way or another, whether it's through pension funds, insurance bonds, unit trusts, or directly into shares. And because of the vast size of most funds, unless you decide to switch your small part of the total, it will more than likely remain in the same area for a very long time. And so what happens? It goes up, it comes down, it goes up again, and so on, entirely at the mercy of the whims of the market. So even if the end result is higher than the start, it will have meant a catalogue of missed opportunities. In 1929, during the Wall Street crash, $100 invested then would have fallen to only $10 in less than 2 years. The British stock market in 1974 was only slightly better. The fundamental rule in any kind of trade is buy low, sell high. And yet most investors don't do this at all when it comes to their shares, pensions, unit trusts, or bonds. In fact, many people do exactly the opposite, buying only when they've seen a track record, and either selling when it's too late, or not selling at all while they're waiting for a recovery. Why? Lack of information and lack of time. But it simply isn't necessary for you to lose out that way, and I want to show you why. Hello, Sue. Well, now what we're going to see is a really remarkable development in the world of investment analysis, a service which, if you choose to use it, will make you a member of a pretty exclusive club. By placing your investment affairs with a financial advisor who can provide this unique service, you will not only protect your capital, but enhance it. Updated every morning, there is instant access to all the world's markets, currencies, pension funds, unit trusts, insurance and investment bonds, commodities, world share prices, and so on. Comprehensive? Yes, but that's not all. The really unique feature is that through rapid computer analysis, it takes this data and other information, and by using very sophisticated techniques, actually highlights the time to buy, when to hold, and the all-important when to sell. In this way, buying or selling units in a pension fund, bond, or unit trust can be anticipated before a major move takes place. That's it. Sounds simple, doesn't it? But behind the scenes is the support of a central investment data service, the only one of its kind in the world. Each week, thousands of unit trusts, bonds, pension funds, commodity prices, and shares are analyzed to calculate the leading potential funds to buy and sell, and perhaps most important of all, to provide a weekly double check to ensure that these decisions are beating the average of other investment areas. Each morning, a team of operators updates the computer files on all of the investment areas covered. Altogether, a staggering 112 million prices are passed to subscribers in a year. By 11 o'clock each morning, the analyzed data is ready to be passed to your advisor. How? Like this. Go ahead, Sue. And because of the strict control on the number of subscribers and the confidentiality of his service, a secret password has to be entered to prevent unauthorized access. After only a few minutes, the updated information is transferred to the advisor's terminal with comments and summaries on decision recommendations. Sophisticated technology? Yes, but in reality, it's only just a super-fast brain, a tool if you like. The secret is a research spanning more than 13 years, based on successfully proven theories that have been used since the turn of the century. Of course, it would take me hours or even days to cover the depth of that research. That's something that you can take up with your advisor. But now I think it's time to see just how it works. Sue, would you like to call up, say, a unit trust for us?
Okay.
Of course, this example could have been an insurance bond or any other kind of fund. Now here we can see the performance of the Fidelity Japan Unit Trust over 4 years. And during that period, the analysis picked it out as the leading performer in late 1982. As you would expect, there were lots of rises and falls. From April 1984 to July 1984, there was a significant 15% fall. Now at that time, you'd have needed to know whether the fall was temporary or the start of a prolonged fall which would erode your considerable profit. Secondly, you'd wish to know whether there was another unit trust that would do better in future. With the help of the vast resource of the computer to analyze performances at lightning speed, all the other unit trusts in the market were analyzed to see if a switch should be made. The analysis made each week confirmed that Fidelity Japan should be held. Here's an example of how the comparison was made against one of the most consistent unit trusts on the market, Framlington Capital. As you can see, the chart at the time of decision is showing the comparison above the blue average line. A fall below the line would indicate a switch to Framlington. This did not occur against this fund or any other fund at the time, so the decision to hold Fidelity Japan was confirmed. However, the next correction from October 84 to December 84 was a different story. The number 2 in the recommended units at that time was Gartmore Hong Kong. As you can see, the comparison with Fidelity Japan in late November 1984 provided the signal to switch from Fidelity Japan to Gartmore Hong Kong. A similar comparison with all other unit trusts showed Gartmore Hong Kong in the ascendancy. This situation remained until March 1985, when TR Special Opportunities Unit Trust signaled a switch from Gartmore Hong Kong. The results have been exceptional due to the existence of a bull market period, but also because of the fund switching technique used. Fidelity Japan rose by a remarkable 295% from 1982 to the switch date on the 25th November 1984. After that, it dropped by 21%, while Gartmore Hong Kong rose by 15% and TR Special Opportunities by 30%. The result of the switching over 34 weeks from November 1984 was a 28.1% rise, and this in a period of time when neither the FT30 nor the Government Securities Index and most foreign markets adjusted for the strength of the pound made any profit at all. So there you are, a dramatic performance achieved by a constant evaluation of the facts as they emerge, with no need for subjective judgment. The market itself tells you when to act. Thanks, Sue. So how can your financial advisor put this service to work for you? Well, the first thing is to talk to him. We have really only just scratched the surface of the potential. But one thing is clear. While it's vital to select the right company and fund for your savings plan, pension fund, lump sum bond or unit trust, it's even more critical to keep them under constant review, under active management, and to be prepared to alter course when markets like this change. Having seen all this, I wonder how Mr. Barker is feeling now. And now that you've recovered, Mr. Barker, how do you feel about the future?
Confident. Much more confident. Could we just turn the clock back a little and have another go? Is there any chance of having that computer by my side? Oh, by the way, who should the viewers get in touch with?
Glynn Goodwin, where performance counts. Make sure your money is ahead of the pack. Come and talk to us over a cup of coffee. Glynn Goodwin Company, 35 Thorncliffe Road, Napoli Park, Nottingham, NG3 5BQ. Or telephone Nottingham 625 840.